Silver investors, the West is looking at a calm silver chart and saying, see, the squeeze is over. But inside China, the real silver market is on fire. Inventories at decade lows, front-month contracts at record premiums, and short sellers literally paying fees just to avoid delivering metal they don't have. I'm OG John AG, and in this video, I'm going to show you why China's silver crunch is not over, why the big squeeze is still on even as prices look steady, and what this split between calm Western prices and stressed Chinese markets really means for silver going into 2026. Segment 1. The illusion of calm, what the global chart is hiding. Let's start with what most people see. Globally, silver prices right now look stable. No vertical spikes, no fresh all-time high this week. FX Leaders describes it as prices that have steadied after recent volatility. So the average investor looks at that and thinks, okay, the panic is over. The January squeeze burned out. But scroll down in that same FX Leaders piece and you see a very different picture inside China. Persistent supply crunch. Ongoing stress and physical availability. Market signals screaming tight even though headline price is calm. In other words, the surface is calm. The plumbing is still bursting. Whenever you see that mismatch, flat global price, stressed local market, you are not looking at normalization. You are looking at a pressure cooker with the lid forced down. Segment 2, China's silver crunch. What's actually happening on the ground, FX Leaders lays it out clearly. China's silver market is still in a big squeeze. A powerful wave of investment and industrial demand has rapidly drawn down stockpiles. They highlight that. Domestic producers are struggling to keep up with demand. There is a backlog of orders. Producers simply cannot fill everything on time. When producers can't keep up, you get short-term prices being pushed higher domestically, tighter spreads and more aggressive bidding for near-term delivery. FX Leaders notes that this is translated into short-term steep price spikes in China, even though the global price chart looks flat. That's the definition of a crunch, not just high prices, but difficulty actually getting metal when you need it. So while Western analysts are busy saying silver's cooled off, China is quietly dealing with a market where the shelves are thin, the pipeline is strained, and buyers are willing to pay extra to get metal now, not later. Segment 3, backwardation, when now is worth more than later. One of the loudest signals in this article is a word most retail investors ignore, backwardation. FX Leaders reports that the front-month silver contract on the Shanghai Futures Exchange, SHFE, is trading at a record premium over longer-dated contracts. That means silver for immediate delivery is more expensive than silver for delivery months from now. In a normal, well-supplied market, you usually see contango. Future prices are higher than spot because of storage, financing, and time value. Backwardation flips that. People are saying, I don't care about later. I need the metal right now, and I'll pay extra for it. That's what's happening in China. The front-month SHFE contract is in steep backwardation, signaling an urgent need for physical metal in the near term. This is critical. You can fake a calm price on a Western screen. It is much harder to fake widespread backwardation and record front-month premiums in the world's biggest consuming country. Backwardation is the market's way of screaming. There is not enough metal in the right place at the right time. Segment 4. Short sellers paying to run away from delivery. Now it gets even more revealing. FX Leaders points to the Shanghai Gold Exchange, SGE, where silver is also traded in a physically settled environment. They report that short sellers on the SGE have been paying deferral fees to avoid delivering metal on contracts that have come due. Let that sink in. If you are short and you have the metal, delivering it is straightforward. If you are short and you don't have the metal, you have two ugly choices. Go into the market, buy at a high price, and deliver at a loss, or pay a deferral fee to roll your obligation forward and pray things calm down later. When FX Leaders tells you that shorts are choosing to pay deferral fees rather than deliver, it means they cannot or will not produce the metal at current market conditions. It's cheaper to pay penalties than to actually find the silver. That is not a healthy market. That is a market where paper promises have run ahead of physical reality, and now the bill is coming due. If you're looking for a real-world indicator of paper stress in silver, this is it. Shorts paying to delay reality instead of facing it. Segment 5. Warehouse inventories, the lowest in a decade. FX Leaders adds another hard metric, inventories. They highlight that. Combined inventories on the Shanghai Futures Exchange and Shanghai Gold Exchange have dropped to their lowest levels in 10 years. 10-year low stockpiles in the world's largest consuming country is not a small detail. It means years of strong demand have eaten through available above-ground supply. The recent rally in volatility did not rebuild those inventories. In fact, FX Leaders reminds us that silver prices in China shot up 61% in the first half of January alone, before suffering a sharp correction. Even after that crash, the inventories did not refill. So what does that tell you? The spike forced some weak hands out on price, but it did not magically create new mine supply. The underlying shortage of readily available silver in China remains. A price correction without an inventory rebuild is not the end of a squeeze. It's the pause in a squeeze. Segment 6. Why global prices look steady while China is tight. So how do we reconcile the two realities? Global chart. Silver looks relatively steady after a volatile period. China. Backwardation. Record front-month premiums. Decade-low inventories. Short sellers paying deferral fees. FX Leaders frames it like this. Despite the domestic crunch, international silver prices have stabilized, suggesting that global participants might be underestimating the severity of the Chinese tightness. There are a few reasons why this disconnect can exist. Western focus on COMEX and London. Many investors only watch U.S. futures pricing and ignore regional stress signals. Lag in global sentiment. It takes time for local tightness to translate into global pricing, especially if Western traders still believe it's transitory. Paper markets muting the signal-heavy use of futures and ETFs can suppress price in the short term, even as physical conditions tighten. But that disconnect is not sustainable forever. At some point, either Chinese conditions ease materially, inventories rebuild, backwardation disappears, deferral fees vanish, or global prices wake up and reprice to reflect the fact that the world's key consuming region is still in a squeeze. FX Leaders headline says it all. Big squeeze lingers, China's silver crunch persists as prices steady. The squeeze is still there. The price just hasn't caught up yet. Segment 7. The bigger picture. Structural demand versus short-term corrections. Let's zoom out from China to the global context. FX Leaders reminds readers that silver demand comes from two powerful engines: industrial, solar, electronics, EVs, tech. Investment, bars, coins, ETFs, and national reserves. China sits at the intersection of both, massive industrial base. Growing investor interest in precious metals as a store of value. When you get a period like early January where price rallies aggressively, you often see some investment demand cool off briefly, some profit taking. But in this case, even after the 61% rally and the crash, the industrial pull on silver remains strong in China. Inventories remain low. Producers still can't comfortably meet all demand. That's what FX Leaders is warning about. Short-term corrections on a chart do not erase years of accumulated structural tightness. The big squeeze is not just a single price spike. It's the imbalance between what the world, led by China, wants and what the system can deliver without draining stockpiles to the bone. Segment 8, what this means for silver investors outside China. Now let's talk about you, sitting outside China, watching all this from a distance. FX Leaders essentially tells you global prices look steady, but the Chinese market is still tight. For a serious silver investor, that translates to you are being given a calm-looking price in a not-so-calm underlying reality. Practically, this means don't be fooled by a flat line. A lack of fireworks on the global chart does not mean the fundamental pressure is gone. Watch Chinese indicators as leading signals. SHFE front-month premiums. SHFE SGE inventory levels. Reports of deferral fees and short stress. Understand time lag. It can take months for local tightness to fully express itself in global price, especially in a world where Western paper still dominates headline price discovery. In that lag, you either build positions while the rest of the world sleeps on the story, or wait until the headline hits and chase a move that started months earlier inside China. FX Leaders is effectively saying the crunch is still here. The market just hasn't repriced it fully. Segment 9. How this fits into the broader East-West silver story. This isn't just one Chinese article. It fits a pattern we've been watching. China and other Asian markets steadily increasing their presence as key silver consumers and investors. Western paper markets often muting or delaying the price response to real-world tightness. The big question is, who ultimately decides the fair value of silver? The derivatives traders in New York, or the factories and investors in China, India, and the rest of Asia? FX Leaders' report on China's crunch suggests the East is already behaving as if silver is scarce at current levels. The West is still trading it like just another ticker on a screen. In the long run, real demand wins. Charts can be bent for a while. Inventories cannot be faked forever. Segment 10. Final word. Calm price. Loud signal. So here's the takeaway. FX Leaders is telling you that the big squeeze lingers. China's silver crunch persists. Short sellers are paying to avoid delivery. Inventories are at decade lows. Front-month futures are at record premiums. And yet, global prices look steady. If you judge silver only by a calm Western price, you'll miss what's happening underneath. A structurally tight market in the largest consuming country on Earth. A physical reality that does not match the relaxed tone of the global chart. You've been watching John AG here, and I'm OG John AG. If this helped you see that the real silver story in 2026 is not crashes over back to sleep, but China is still in a crunch while prices pretend everything is fine, hit like, so this doesn't get buried, smash subscribe with all notifications on, and drop a comment. Big squeeze still on or over? Tell me where you stand after seeing the data, because on this channel, we don't just look at the price, we look at who's running out of metal behind that price.